The weekday began the way most weekdays begin in a city with a large service and hospitality workforce, with expectations already in motion before anyone arrived at a desk. Payroll runs had been submitted to ACH originators in the preceding days, processed through the standard batch cycle, and forwarded by Friday close or Monday morning to the Federal Reserve's ACH network or to private sector operators handling interbank clearing. The originating depository financial institutions, known as ODIFs, had released their files within the standard transmission window. On the receiving side, receiving depository financial institutions, the RDIFs, had acknowledged the files. Settlement was scheduled. Credit entries were queued. For the majority of Miami-Dade County's working population, hotel staff, logistics workers, healthcare aides, municipal employees, gig platform recipients using direct deposit, the expectation was that funds would be available by 9 in the morning or by opening of business at the latest. That expectation was embedded not in any individual decision, but in the structural assumption that the ACH settlement cycle would perform within its published parameters. On this day, those parameters were met in some respects and not met in others, and the distance between those two outcomes was not visible to most of the people who depended on the result. The ACH network operates on defined settlement windows. The Federal Reserve's Fed ACH service offers same-day ACH credits through 3 settlement windows, each with its own submission deadline and associated settlement time. Standard ACH credits, submitted in the prior day batch, settle the following business day, typically at 8:30 a.m. Eastern for the first interbank settlement posting. What actually reaches an individual account, however, depends on a separate set of decisions made by the RDIF, the bank or credit union holding the recipient's account. RDIFs are required to make ACH credit funds available to account holders no later than the settlement date, but the precise internal posting time varies by institution, by system batch schedule, and by the volume of transactions being processed during that cycle. On this particular day, the settlement files moved through the Federal Reserve infrastructure on schedule. The interbank accounting entries were posted. What did not occur at the expected time was the downstream posting to individual consumer and business accounts at several large institutions serving the Miami metro area. The delay, measured in hours rather than days, did not trigger any regulatory threshold for late availability, but for the people waiting, the distinction between settled at the network level and posted to my account was not a technical abstraction. It was the difference between a card working at the gas station or not. To understand how a delay accumulates, it is useful to trace the sequence of dependencies. An employer using a payroll service provider submits payroll data several days in advance. The payroll provider aggregates that data, formats it into NACH-compliant ACH files, and transmits those files to its own bank, the ODFI, by a designated cutoff time. The ODFI then forwards the file to the ACH operator, either Fed ACH or the clearinghouse's EPN network, within the operator's submission deadline. The ACH operator sorts the transactions by receiving institution and transmits the outbound files to each RDFI. The RDFI receives the file, validates the entries against its own records, and queues the credits for posting in its next available batch cycle. Each of these steps has a defined timing parameter, but the parameters compound. If a payroll provider submits late, or if an ODFI transmits near its cutoff, or if an RDFI's overnight batch cycle runs longer than expected due to volume, the end result shifts. On this day, the available evidence suggested that the delay originated in the RDFI batch processing layer. The interbank settlement had cleared, the files had been received, but the internal posting queues at 2 or 3 major retail banking institutions serving Miami accounts ran past their standard completion windows. The accounts showed pending credit entries. The funds were not yet available for withdrawal or purchase. By mid-morning, the pattern was becoming visible through a specific class of observable events, none of which were dramatic in isolation. Point-of-sale transactions declined for insufficient funds at grocery stores and pharmacies in neighborhoods with high concentrations of service sector workers. Rent payment platforms began logging failures on scheduled automatic debits where the tenant account showed an anticipated but not yet posted direct deposit. Small business owners who relied on employee payroll being settled before opening were managing cash flow questions at their registers. Mobile banking applications showed account balances with notations like pending or processing next to direct deposit line items, rather than confirmed posted credits. Customer service call volume at the affected banks increased. Social media posts and local community groups noted that direct deposits had not arrived. These observations did not indicate a bank failure or a systemic outage. They indicated a timing gap, a condition in which the system had functioned correctly by the standards of the network while producing incorrect outcomes by the standards of the people relying on it. The distinction mattered structurally. It also mattered practically in ways that were distributed unevenly across income levels and account balance margins. The institutions involved in this kind of delay typically have little visibility into the downstream consequences of their posting schedules until they begin receiving inbound customer inquiries. A bank's operations center is focused on file receipt confirmation, exception handling, and posting queue management. Its system logs show timestamps: when the ACH file was received, when it entered the posting queue, when the batch job ran, when accounts were updated. A delay in that sequence appears as a latency metric, a deviation from the standard processing window, rather than as a customer impact event. The customer impact is happening simultaneously and separately. The person at the pharmacy, the landlord's automated payment system, the utility autopay that draws from an account 2 hours before the deposit posts. These downstream events are not logged by the bank at the moment they occur. They become visible through call volume, through dispute filings, through overdraft fee triggers, through transaction failures captured by merchants. The temporal gap between the processing delay and the institutional awareness of its effects was itself a structural feature of the day, not an anomaly. Banks are designed to process files, not to track the social consequences of posting latency. The population most directly affected by a morning posting delay in Miami-Dade County is identifiable through labor market and banking access data. A significant share of the county's workforce is employed in accommodation and food services, healthcare support roles, retail, and transportation, sectors with high rates of biweekly or weekly payroll cycles, high rates of direct deposit adoption, and lower average account balances. Lower account balances mean that posting timing is more consequential. An account with a balance above a debit threshold before a deposit lands behaves differently from an account that requires the deposit to cover that morning's transactions. This is not a judgment about financial behavior. It is a description of how buffer capacity interacts with settlement timing. A payroll delay that is invisible to an account holder with a large existing balance becomes materially significant to an account holder whose balance depends on the deposit arriving before their rent auto payment executes or before they attempt to purchase groceries on a workday morning. Miami's demographic profile, high immigrant population, high share of workers in cash flow sensitive employment, high cost of living relative to median wages, meant that the distribution of impact from even a short posting delay was not random. It followed the contours of the underlying financial margin structure of the population. Overdraft fee logic operates automatically. When a debit transaction arrives at a bank before a credit entry has posted, the system applies one of several pre-configured responses. It declines the transaction, it covers the debit and assesses an overdraft fee, or it honors the transaction under an overdraft protection arrangement linked to another account or line of credit. These responses execute without human review in the vast majority of cases. On a day when payroll deposits were delayed in posting, overdraft fees were assessed on accounts where the debit arrived during the gap. Some of those fees would later be reversed upon customer request after the deposit posted and the customer called the bank. Reversal is not guaranteed and varies by institution, account relationship, and the customer's history of requesting reversals. For the portion of fees that were not reversed, the cost of the posting delay was transferred from the bank's processing timeline to the account holder's balance. The aggregate amount of those fees across all affected accounts at all affected institutions was not publicly reported and is not recoverable from public records. It existed as a diffuse financial redistribution, invisible as a category even as it was precise in its execution at the transaction level. By early afternoon, posting had completed at most affected institutions. The direct deposit line items that had shown as pending began appearing as posted credits. Account balances updated. Declined transactions that customers attempted to reprocess began succeeding. Rent payment platforms saw some of their queued retries processed successfully. The day's peak service sector shift start times, noon and early afternoon, coincided closely with the normalization of posting for many accounts, which meant that workers entering their afternoon shifts had access to their funds before making transit or meal purchases on their way to work. For the morning shift population, those who had needed funds between 6 and 10 in the morning, the correction was retrospective. The transactions that had failed had already failed. The overdraft fees that had been assessed had been assessed. The purchases that had been deferred had been deferred. The system had corrected itself within the same business day, which meant that by the standard settlement definitions, it had not violated any availability requirement. The day's irregularity was, in regulatory terms, within bounds. No public regulatory filing documented this event as an incident. The affected banks did not issue press releases. No ACH operator published an advisory. The Federal Reserve's payment system status pages remained clear. This was consistent with how posting delays of this kind are categorized. They are operational variances, not outages. An outage involves unavailability of the payment infrastructure. A posting delay involves latency within a functioning system. The NACHA operating rules specify that RDFIs must make ACH credit funds available to account holders by settlement day, but they do not specify the intraday posting time beyond that deadline. If deposits post by end of business on the settlement date, the institution has met its obligation under the applicable rules. Whether posting occurred at 7 in the morning or at noon or at 3 in the afternoon is, by rule, a matter of internal operational practice. This is not a gap in the rules so much as it is a reflection of how the rules were written. They were written to protect against late availability across settlement dates, not to regulate the distribution of posting times within a settlement date. The difference between those two things is where the human experience of the delay resided. Documentation of this class of event relies on inference from observable data rather than from direct incident reporting. Account-level posting timestamps are held by individual financial institutions and are not aggregated into any public data set. Overdraft fee data is reported at the institutional level on an annual basis, not disaggregated by cause or by date. Call center volume logs are internal. Social media records are unstructured. What remains for review purposes is the structural logic. The ACH settlement cycle was designed with specific assumptions about when ODFIs transmit, when ACH operators sort and forward, when RDFIs post, and when consumers interact with funds. Each of those assumptions has a designed parameter and an actual distribution. On days when the actual distribution shifts toward the late end of its range without exceeding the defined threshold, the designed experience and the lived experience diverge. The settlement threshold is met. The operational assumption of morning availability does not hold for a portion of the population. The gap between those two facts is not an exception. It is a latent condition within a system designed to handle payment volume at scale, in which timing precision at the infrastructure level does not guarantee timing consistency at the account level. Review of ACH operator guidelines, NACHA rule sets governing availability obligations, Federal Reserve Fed ACH service descriptions, and CFPB research on overdraft fee triggers and account balance distributions provides the framework through which this day, and days like it, can be understood as an ordinary feature of the system rather than an anomaly within it.